Hey everyone, it's John Reuter from Integrity Homes and War Heroes. This is the year-end housing market briefing for Wisconsin and taking a deeper look at Dane County as we are in 2026 already. 2025 flew past. This audio is based on statewide and local market data, trends we're seeing on the ground, and the questions that actual buyers and sellers are asking us right now, especially inventory, pricing, and affordability. If you're thinking about buying or selling or just want a clear picture of where the market stands heading into 2026, well, we're in 2026. This will give you a solid view. And as always, if you have any questions, feel free to reach out anytime.
Welcome back to the deep dive. It is late January 2026. The holidays are finally in the rear view mirror, and at least here in the Midwest, there's plenty of snow on the ground.
hmm
And usually, right about now, we just complain about the wind chill. But today, we are looking at the one thing people talk about even more than the weather.
The housing market.
That's the one. And usually those conversations are just vibes, it's anecdotes, it's feelings. But today, we aren't doing vibes. We actually have the hard numbers for how 2025 finally closed out.
We do. We've got the full year Wisconsin housing market report and the more specific Dane County market snapshot.
And our mission today is to solve a bit of a mystery.
Right. Because Wisconsin just logged its second straight year of improved sales. The market's growing. We need to figure out why that happened and, maybe more importantly, why Dane County is behaving like a completely different animal.
It really is a tale of two markets.
Yeah.
So the headline for the state of Wisconsin looks surprisingly rosy. Sales up, prices up. It wasn't a crash, it was a climb. But I have to ask, was 2025 actually a good year, or was it just, less bad than the year before?
That is the right question to ask. And to understand 2025, you really have to look at how it ended in December.
Which is usually a throwaway month, right? Nobody wants to move during the holidays.
Exactly. The market usually goes into hibernation, but December 2025 was, well, the report calls it impressive. Existing home sales rose 4.4% compared to the year before, and median prices went up 2.5%.
Okay, hold on. I want to challenge that word impressive. I mean, 4.4% growth is solid, sure, but is that really worth popping champagne over?
Well, context is everything here. You have to remember what happened in December 2024. That was not a weak month.
Oh, okay.
December 2024 actually saw double-digit growth. It was a boom. So to beat that performance, that's incredibly difficult.
So we're not just bouncing back from a low point. We're stacking growth on top of growth. It's an expansion.
Exactly. It shows real sustained demand.
Okay, so if December was the strong finish, what's the final scorecard for the entire year?
For all of 2025, sales for the state were up 2%, and the median price rose 4.8% to land at $325,000.
$325,000. And I noticed something interesting from Amy Curler, the WRA chair. She sounded almost relieved that the price increase was only 4.8%.
Which sounds completely backwards, right?
Absolutely. If I own a house, don't I want my biggest asset to go up as much as possible? Why would I want it to slow down?
Well, if you're selling tomorrow, sure, but for a healthy, functioning market, no.
Mm,
When appreciation is running at 10 or 12%, that's a runaway train.
right.
That's a bubble. Seeing it cool down to just under 5% suggests sustainability. It means prices are rising, but they aren't sprinting away from people's incomes quite so violently.
It's the difference between a healthy jog and a heart attack.
That is a perfect way to put it. We want the jog.
Now, whenever we talk state averages, I always wonder if the data is being skewed. Is this just Milwaukee and Madison dragging the average up?
You would think so, but no. That is what's remarkable here. It is incredibly widespread. Every single region in the state showed annual growth,
Every region, even the rural north.
especially the rural north. In fact, the north region was the winner for sales growth, up 6.7%.
Really?
Yeah. And even the slower regions saw gains. And for prices, 4 out of the 6 regions saw appreciation between 5.6 and 7%. So you almost certainly gained equity in 2025, no matter where you live in Wisconsin.
Okay, so the demand is there, but we have to talk about supply. Because for, 3 years now, we've been hearing this broken record of inventory is low. Is that still the case?
Unfortunately, yes. And the data here is actually a little alarming if you're a buyer.
How bad is it?
Well, total listings grew slightly, but new listings, the fresh for sale signs, actually dropped 5.9%.
Wait, walk me through that. How can total listings go up if new listings are going down?
It means houses are just sitting a little bit longer.
Yeah.
We aren't replenishing the supply with fresh inventory. We're just recycling what hasn't sold yet. And here is the stat that really puts it into perspective. A balanced market is usually defined as having 6 months of supply.
6 months is the target. Where are we at?
To get back to that 6-month benchmark in Wisconsin, total listings would need to increase by 107%.
107%.
We literally need to double the number of homes for sale just to reach a neutral playing field.
That doesn't seem solvable in a year.
Yeah.
Or even 2.
Exactly. It's a massive gap.
Yeah.
And it explains why prices keep rising.
But why aren't people selling? If it's a seller's market, why not cash out?
It's the lock-in effect. If you're sitting on a mortgage rate of 3% from a few years ago, and the current rate is over 6%.
You're not moving unless you absolutely have to.
Right. You'd be swapping a cheap mortgage for an expensive one, so people are staying put.
Which brings us to the money side. Mortgage rates. We started 2025 in a pretty rough spot, didn't we?
We did. A year ago, rates peaked at nearly 7%. That was a huge psychological hurdle. But the good news is, they've drifted down. By the end of the year, we were sitting at 6.19%.
Okay, 6.19. It's better than 7, but let's be real, it's not 3.
It isn't. But that drift downward matters. That little drop helped push the Wisconsin Housing Affordability Index up by 1.5%.
1.5%. That sounds negligible. Does that actually change anyone's life?
On an individual level, probably not. You're right. But in macro terms, it's a massive signal.
How so?
It means the trend has reversed. We aren't getting less affordable anymore. We've turned a corner. It's the first step in the right direction.
Okay, I'll take the win, small as it is. But here's where it gets really interesting for anyone listening who's trying to time this market. There was a fascinating little nugget in the report from Dave Clark about seasonality.
Oh, the seasonal adjustment analysis. This is probably the most actionable advice in the whole report.
It sounds dry, but it felt like a cheat code when I read it. Break it down for us.
So they looked at 20 years of data from 2005 to 2025 to see if there's a mathematically best time to buy a house in Wisconsin.
And the findings.
The best time to buy is right now, specifically between December and February.
The worst months to move. The months where you question why you live here.
The worst weather, yes, but financially, the best. Homes sold in this winter window are discounted about 5.9% on average.
Nearly 6% off just for buying when it's cold.
Basically. And it gets worse if you wait. If you buy in the peak summer months, June through August, you're paying a sunshine premium of about 6.4%.
So let's do the math on that. What's the total swing between buying in January versus July?
It's significant. You're looking at a swing of over 12%. On a $300,000 home, that difference is roughly $36,000.
36 grand. Just by being willing to move your couch through a snowbank.
Essentially, yes. You are paid to endure the Wisconsin winter. In the summer, everyone wants to move. In the winter, only the serious buyers and motivated sellers are out there, and that creates a discount.
I love that, the braving the elements dividend. Okay, so that's Wisconsin. But now I want to shift gears because I have friends in Madison who hear state median price of $325,000 and they just laugh.
And they are right. If Wisconsin is the standard, Dane County is a different planet. It really is a microclimate.
So the state median was $325K. How does Dane County stack up?
The median price for the full year of 2025 in Dane County was $474,900.
Wow, that is a massive gap. That's $150,000 more.
It is. And even just for December, the median was $430,000. So you are paying a huge premium just to live within that county line.
And is the speed of the market different too? Can I at least take my time shopping for my $500,000 house?
Absolutely not. The report calls it a firm seller's market. The inventory supply is only 1.34 months.
1.34 months. And we said we need 6 for balance.
Right. So Dane County is barely a quarter of the way there. The median days on market is 23 days.
3 weeks.
3 weeks from for sale to under contract.
However, here's where I want to dig in. There was a stat about leverage. It seems like buyers are getting a tiny bit of power back.
This is a really subtle but critical shift. They track the percent of list price received. Basically, are you negotiating? In December 2024, buyers were getting an average of 0.12% off the list price.
Which is nothing. You
Yeah.
pay the sticker price.
Exactly, a rounding error. But in December 2025, buyers negotiated 1.16% off.
Okay, 1% isn't huge. On a $400,000 house, that's $4 grand. But is it really a sign of a shifting market?
It's a signal. It means sellers can't just pick a number out of the sky anymore. There's slightly more room for negotiation. It indicates the invincibility of the seller is cracking, just a hairline.
So you might actually be able to offer a little under asking and not get laughed out of the room.
For the first time in a while, yes.
Now let's talk competition. I assume that 1% discount isn't happening everywhere. If I'm a young family looking for a standard home, where am I getting squeezed?
You are getting squeezed in what the report calls the family sweet spot. This is the $300,000 to $499,000 range.
The entry level to mid-level.
It is, and that price bracket accounts for nearly half of all sales, but it has the lowest inventory. Specifically, if you're looking between the $300,000 and $399,000, good luck.
How bad?
It is the hottest, most brutal bracket. There is only 0.71 months of supply.
Less than a month. So if no new houses came on the market, everything would be sold in 3 weeks.
And to put a raw number on it, for the entire county in that price range, there were only 84 active listings in early January.
84 homes for a county with over 500,000 people.
Exactly. You are in a gladiator pit. You have to move fast. You waive contingencies. And you probably don't have that 1% negotiation room we just talked about.
So where is that negotiation happening? The flip side.
The luxury opportunity. If you go above $1 million, the inventory sits at 2.98 months.
That's remarkably closer to balanced. Almost 3 months.
It is. It's almost 4 times the supply of the entry-level market.
Yeah.
So if you're a move-up buyer, you're in a great position. You're selling in a frenzy and buying where you have room to breathe.
Sell where it's tight, buy where it's loose.
Precisely.
Let's do a quick geography check. The report broke down some communities. We know it's hot everywhere. But what are the differences?
Well, if you want the tightest market, you go to Madison proper. About 0.77 months of supply. Fast-moving, high demand.
No surprise there, but what if I want a yard?
Then the data points you towards Sun Prairie. It's an interesting outlier. It's sitting at 1.43 months supply, which is almost double the inventory of Madison.
Why is that? Is demand lower?
No, demand is high, but they have had steady new construction. That helps equalize the market.
Got it. And what about prioritizing schools?
That's Wanakee. It remains very competitive. People move in for the schools and they don't leave, which keeps the supply tight.
And finally, looking west.
Middleton. That's the West Side Premium. You've got great amenities, great schools, but you pay for it.
It really highlights that even within a hot county, there are pockets of difference.
Right. Real estate is hyperlocal. The state numbers tell one story, the county tells another, and the neighborhood tells the real truth.
So let's bring this in for a landing. Here's what I'm hearing. For Wisconsin, sales are up. The market is resilient. Rates are down around 6.19%. And if you're willing to buy right now, in the winter, you could save nearly 6%.
That's the buy now signal. But the caution flag is that inventory is still critically low. We are nowhere near balanced.
And if you're in Dane County, brace yourself. High prices and fierce competition, especially under $500. But keep an eye on that negotiation room. It's creeping up.
It is. And that leads me to my final thought, if I can leave you with a bit of a provocation.
Please do.
We have this paradox. A firm seller's market with critically low inventory. By all rights, prices should be skyrocketing, but days on market are creeping up, and buyers are negotiating bigger discounts.
So the cracks are showing.
It raises a big question. Are we seeing a true cooling trend where buyer fatigue is finally setting in? Or is this just the calm before the storm? If rates drop further in 2026, say, into the high fives, does all that pent-up demand just explode again?
That is the million-dollar question. Are we at the top of the hill or just resting on a ledge before the next climb?
Only 2026 will tell.
Well, we will be here to track it. Thanks for analyzing this with us.
It's always a pleasure.
And thank you for listening to this deep dive into the Wisconsin and Dane County housing market. Stay warm, and we'll catch you on the next one.